Imagine watching two screens at once. On the left, you see the familiar price of silver in New York or London, hovering around a level the market has become numb to after years of range-bound trading. On the right, a feed from Shanghai flashes something that looks like a typo, the equivalent of $100 per ounce. The quotes don't close the gap. Hours pass, days pass, and that gaping spread remains. If prices in a global commodity are supposed to equalize almost instantly through arbitrage, how can one side of the world be paying triple or more for the same metal? At first you assume it's a glitch, then a temporary supply bottleneck, then perhaps some obscure tax or licensing quirk. But as the data come in from shipping manifests vault reports and refinery output, a more unsettling picture emerges. Silver is physically flowing one way from west to east, and the paper promises written against it in Western markets are starting to look less like claims on actual bars and more like IOUs that only work as long as almost nobody asks for delivery. This is where the story of $100 silver in China and Western vaults being drained to feed the East moves from internet rumor into something that, while not literally true today, is rooted in the real financial plumbing of the precious metals market and the way stress tends to surface first in the least flexible part of any system, the physical bottlenecks. To understand why such a price divergence would be so explosive, you need to know how commodities prices are normally kept in line. In theory, if silver is much cheaper in London than in Shanghai, traders can buy bars where they're cheap, ship them, and sell where they're expensive. The profit from that arbitrage should compress the price gap until only shipping, insurance, financing costs, and local taxes remain. In practice, this works reasonably well for oil, copper, and other widely traded materials. And it usually works for gold and silver, too. That's why, for most of modern history, you haven't seen Beijing paying 3 times what New York pays for the same ounce. When there is a premium in China, it has typically been moderate and often explained by import restrictions, VAT rules, or short-term logistics. So if a durable extreme premium ever does emerge, it isn't a curiosity. It would be a red light on the dashboard of the global financial machine telling you that something deeper has broken in the relationship between paper and physical markets. Silver is particularly interesting because it inhabits 2 worlds at once. It is an industrial workhorse, critical to solar panels, electronics, medical devices, and future technologies. Yet it also carries a long monetary history. Before paper currencies dominated, China itself ran for centuries on a de facto silver standard. Taxation, large transactions, and savings were often denominated in silver taels, not just as a commodity, but as a measure of wealth and stability. That cultural memory is not gone, even if it operates mostly below the surface. When Chinese households buy silver bars or coins today, they may do it partly for adornment or speculation, but also because precious metals are one of the few tangible hedges available in a financial system still shaped by capital controls and a dominant state banking sector. On the Western side, by contrast, silver has been demoted from the monetary throne. After the end of silver coinage in most developed countries and the closure of the gold window in 1971, silver became just another commodity in official thinking, even as retail investors and some institutions continue to treat it as a form of crisis insurance. This difference in psychological framing matters when stress starts to build. The East, particularly China and India, tends to treat physical bullion, especially gold, and to a lesser extent silver, as a long-term store of value outside the banking system. The West tends to treat metals as assets to be traded, margined, leased, and hedged using futures and derivatives. So you end up with Western price discovery dominated by paper contracts on exchanges like COMEX in New York and OTC trading in London, and Eastern price discovery increasingly shaped by the willingness of households, refiners, and state-linked entities to part with, or to hoard, actual bars and coins. For as long as supplies are abundant and trust in the financial system is intact, these 2 worlds coexist without too much drama. Silver trades largely within a comfortable band, Western vaults lease and relend their metal, and physical flows across oceans smooth out any temporary dislocations. But silver's unique supply-demand balance makes that apparent stability more fragile than it looks at first glance. Global mine production runs on the order of several 100 million ounces per year, most of it as a byproduct of mining other metals like copper, lead, or zinc. That means supply doesn't respond quickly to a higher silver price, the way it might for a primary metal. If copper prices are weak, but silver is strong, miners don't just dig more silver without also affecting the economics of their main product. At the same time, industrial demand, especially from the solar industry, has been rising rapidly, with some analysts estimating that photovoltaic manufacturing alone could consume 1/3 or more of annual mine output. Add in electronics, medical uses, and traditional jewelry and silverware demand, and you can see why the amount of silver left over each year for investment bars, coins, and ETFs is not as large as it might seem. Now insert a sustained surge in Eastern investment demand into that picture. When Chinese and Indian buyers ramp up purchases of physical silver, they are not buying marginable futures. They're taking delivery of kilobars and 1,000-ounce bars that must be cast, shipped, and stored. If their appetite is large enough, it starts to collide with Western investors' perception that silver is a deeply liquid market where you can always roll your futures contracts or sell your ETF shares without worrying about the underlying stock of physical metal. The tension between those two realities is where the plot thickens. On the surface, the screen still shows an orderly futures price. Underneath, refinery capacity tightens, delivery times lengthen, and premiums on small bars and coins begin to creep up. This is the environment in which the phrase "Western vaults are being drained to feed the East" originates. It is not a literal statement that warehouses in London or New York are empty, but rather a description of a directional flow. Silver mined in the Americas, or recycled in Europe, is increasingly being recast into forms demanded by Eastern buyers and shipped out of traditional Western storage systems into Asian depositories, bank vaults, and private safes. The gold market has exhibited this pattern for over a decade, with large volumes moving from Western ETFs and London bullion banks through Swiss refiners and on to China, India, and the Middle East. Silver has followed a similar, if less publicized, trajectory in recent years. When you put that ongoing migration next to the hypothetical scenario of China bidding silver up to $100 domestically, you can see the outline of a structural squeeze, an ocean of paper claims, priced by Western traders resting on a shrinking base of physical metal, much of which is slowly but steadily flowing east and not readily coming back. The key question becomes, at what point does this slow-motion drift turn into a visible break in the pricing mechanism? When does an Eastern premium stop being a 5% quirk and start to look like a signal that the world is moving toward two different prices for the same metal, one for paper in the West, another for physical in the East? The answer lies in the details of how silver is stored, traded, and accounted for, and in the willingness of arbitrageurs to keep bridging that gap with real bars pulled from Western vaults. If and when those arbitrage flows hit hard limits, regulatory, logistical, or simply the psychological unwillingness to part with remaining stocks, the seemingly abstract notion of $100 silver in China becomes less science fiction and more a preview of a potential fracture in the global monetary order. Behind every flashing price quote for silver is a stack of contracts, warehouses, and trust relationships that most people never see. The public tends to focus on visible products, coins, bars, ETFs, while the real price setting happens in the institutional shadows: futures exchanges, over-the-counter forward markets, leasing agreements, and unallocated metal accounts. To understand how Western vaults can be drained without triggering immediate panic, you have to see how much of the silver traded in New York and London is not a specific bar with a serial number in a specific cage, but a promise from a financial institution that it can get such a bar for you if you ever bother to ask. In London, the core market is an over-the-counter network of bullion banks and large dealers that trade silver bilaterally. Much of this metal is held on an unallocated basis, meaning customers own a claim on the bank's pool of metal, not titled to particular bars in a named vault slot. An unallocated ounce is effectively a credit exposure to the custodian, backed by its general metal inventory and balance sheet. This structure is flexible and convenient. It allows large volumes to change hands with simple book entries, without trucks and forklifts moving pallets of bars. But it also means that the same pool of physical silver underpins many layers of claims. In industry shorthand, people speak of leverage, the ratio of paper ounces to physical ounces, if the open interest in futures and forwards is a multiple of the metal readily available for delivery. The system assumes that almost nobody will demand to convert their paper into bars at the same time. On COMEX, the main U.S. futures exchange for silver, a similar dynamic plays out in a more transparent format. Contracts are standardized, margins are posted, and open interest is published daily. The exchange also reports inventories held in approved warehouses split into registered, available to satisfy delivery on futures contracts, and eligible, meeting the standards but not currently pledged to fulfill contract delivery. Observers often compare open interest to registered stocks and note that the ratio can reach high numbers. Many times more paper silver is traded than exists in the registered category. Critics use this to argue that the market is inherently unstable, that a concerted wave of long standing for delivery could trigger a default. Defenders counter that futures markets are not warehouses, they're risk transfer venues, and most participants close or roll their contracts without ever touching a bar. Both sides have a point. Derivatives exist precisely so that producers, consumers, and speculators can hedge and trade without constantly moving physical. However, the comfort with leverage and with unallocated positions relies on an important assumption. Physical silver can always be sourced in sufficient quantity at a modest premium to meet the delivery needs of those few who truly insist on it. That assumption holds easily in times of surplus, but it becomes fragile in a world where industrial demand, investor interest, and Eastern accumulation steadily grind away at above-ground stocks. When London Vault holdings, as reported by trade associations and custodians, decline year after year, and COMEX registered inventories slip to multi-year lows, the abstract leverage ratio starts to look less like a benign feature of modern finance and more like a potential pressure point. There's also a subtler mechanism by which Western vaults lose metal without a visible run. Large silver ETFs, such as those listing in New York or London, hold their metal in custodial vaults and issue shares backed by ounces. When investors sell ETF shares, the fund can redeem baskets with authorized participants, who may then decide whether to resell the metal into the Western system or ship it elsewhere. During periods of sustained outflows, these vehicles can see significant reductions in their reported holdings. Officially, nothing alarming has happened. Investors simply chose to rotate out of one asset and into another. Yet from a physical perspective, what may have happened is that sovereign buyers or large refiners in the East used those liquid transparent ETFs as a convenient source of supply, taking delivery, recasting the bars, and sending them across oceans. At no point in this chain does a bright red siren go off saying, default. All obligations are technically honored. The futures exchange meets its delivery requirements. The ETF meets redemptions. The bullion bank, if pushed, can tap remaining inventory or pay a premium to replace bars it has loaned or sold. But each of these steps chips away at the cushion of metal that makes everyone comfortable with unallocated claims and high paper to physical ratios. If the drawdown is gradual, it feels manageable. Inventories are still large in absolute terms, after all, measured in hundreds of millions of ounces. Market participants reassure themselves that silver is abundant in the Earth's crust, and that recycling can always make up the difference. The trap in that reassurance is that the bottleneck is rarely geological. It is logistical and financial. The question is not how much silver exists in theory, but how much can be mined, refined to good delivery standards, and transported to the right vaults on a timetable that matches contractual obligations. Mining projects take years to bring online. Refineries have finite throughput. Shipping lanes can become congested or politically constrained. Meanwhile, financial claims can multiply with a few keystrokes. In a low-stress environment, the system absorbs all of this. In a high-stress environment, say a surge in Eastern demand combined with geopolitical tension and supply chain disruptions, the gap between the speed of paper creation and the speed of physical mobilization can suddenly matter. This is where the idea of Western vaults being drained to feed the East begins to intersect with the hypothetical of $100 silver in China. Imagine that, for whatever reason, concern about currency stability, rising wealth, state directives, or industrial stockpiling, Chinese entities decide they want to increase their holdings of physical silver significantly. They are price insensitive up to a point, viewing the metal as a strategic reserve rather than a short-term trade. They buy from domestic sources, then from imports, then from any channel that can deliver real bars. Internationally, the path of least resistance is through Western vaults, where metal is already held in good delivery form and is legally and logistically easy to move. As long as Western institutions are willing to part with metal at prices anchored to the familiar futures benchmarks, the flow continues. The divergence between Western and Eastern prices shows up first only as a creeping premium for certain forms and locations, not as a headline number. However, as inventories tighten, the cost of prying loose additional bars rises. Premiums on physical deliveries in Asia may climb faster than the underlying futures price. Small investors might see that as higher premiums on coins and small bars. Larger buyers might face longer waits and steeper charges for kilobars and 1,000-ounce bars. Arbitrageurs try to bridge the gap, but they are constrained by financing costs, regulations, and increasing risk that the spread they are betting on will close in ways they didn't expect. At some point, the marginal Western holder of silver refuses to sell at the old futures anchored price. They either want a higher dollar number or they want to keep their hedge against systemic risk. That refusal is the quiet moment when a perfectly functioning, high-leverage paper market discovers that the physical backing it assumed was there may, in fact, have found a new home on the other side of the world. In such a setting, the tension builds invisibly. The daily price quotes still move in familiar bands. Analysts still publish reports based on cost curves and discounted cash flows. Yet underneath, the market's elastic has been stretched. The more it is pulled, by Eastern demand, by dwindling Western stocks, by rising industrial usage, the more abrupt and violent the snapback will be when it finally gives way. If the Western system is the world of unallocated claims and high leverage price discovery, China represents almost the opposite, a semi-closed arena where physical flows, state policy, and capital controls can produce localized prices that diverge sharply from international benchmarks. To understand how silver could theoretically reach $100 per ounce in China, While remaining much cheaper elsewhere, you have to look at the specific plumbing of the Chinese precious metals market and the incentives of its key actors. China operates major exchanges for precious metals, notably the Shanghai Futures Exchange and the Shanghai Gold Exchange. These platforms handle both futures and spot contracts, with physical delivery playing a more central role than on many Western exchanges. Gold, in particular, sees significant volumes settled with actual bars delivered into or out of exchange warehouses. Silver is smaller but follows a similar logic. Importantly, China ACE government keeps tight control over capital flows and over which entities can import or export bullion. In gold, the country has historically limited export and required import licenses, effectively ensuring that once metal enters China, it tends to stay there unless the state itself decides otherwise. While silver has been treated somewhat more flexibly, changes in tax policy, environmental rules on smelters, and strategic considerations can all alter the flow overnight. Then there are taxes. In China, value-added tax on silver can create a wedge between international prices and domestic retail prices. If a bar of silver crosses into China, it may be subject to VAT that is not always fully recoverable by end buyers. This pushes up the all-in cost compared to a bar sitting duty-free in a London vault. In tranquil times, this wedge is modest. Arbitrage and domestic refining keep domestic prices tethered reasonably closely to global ones. But if the authorities restrict imports, clamp down on export rebates, or change VAT treatment in ways that disadvantage outflows, the effective cost of new silver entering the domestic market can leap. Combine that with rising household and industrial demand, and you have the ingredients for a much higher local price. China's industrial appetite for silver is not theoretical. It is the world's largest manufacturer of solar panels, and silver paste is a critical input to photovoltaic cells. While technological advances aim to reduce the amount of silver used per panel, absolute demand has surged as installed solar capacity has grown. Add electronics, 5G infrastructure, electric vehicles, and traditional uses, and Chinese factories soak up vast quantities of silver each year. If domestic mine and scrap supply cannot keep up, imports must fill the gap. In a normal global environment, that is easy. Ships and planes move metal, Western vaults supply it, and prices converge. In a stressed environment, think trade friction, sanctions, geopolitical angst, China might view guaranteed access to silver as a strategic priority, much as it already treats rare earth elements in certain energy supplies. From a policy perspective, the Chinese state has multiple levers. It can direct state-owned banks and enterprises to build strategic inventories. It can offer favorable financing terms to firms that hold physical metal, effectively socializing the carrying cost. It can adjust taxes and regulations to make exports of silver, whether as bars or embedded in products, less attractive. And it can use moral suasion and media messaging to frame precious metals as a safe store of value for households during times of currency uncertainty. None of this requires an explicit announcement that we are pushing silver to $100. It simply changes the incentive structure in a way that channels domestic savings and industrial planning toward accumulating physical metal. In such a scenario, domestic Chinese prices could begin to systematically exceed Western benchmarks. At first, the difference might be 5 or 10%, then more. Traders with the right licenses and financing would import as much as they could, arbitraging the gap. But because China's capital account is not fully open, not everyone can engage in this game. The set of entities allowed to import bullion is finite, and the state can ration licenses. If it chooses to restrict these flows, say because it wants strategic metal to remain on shore, or because it fears financial instability from large cross-border positions, the arbitrage mechanism that normally equalizes prices will weaken. Domestic prices can then rise further, reflecting local scarcity and strong demand unconstrained by the same macro headwinds that might depress Western speculative buying. The phrase $100 silver should be understood here not as a precise prediction, but as shorthand for a regime shift. A world in which the marginal buyer in China is willing and able to pay dramatically more for the next ounce than the marginal Western futures trader thinks it is worth. That kind of revaluation can happen quickly in relatively closed markets. We have seen examples in other commodities and in other countries. Local grain or fuel prices soaring above world prices during shortages, domestic gold prices trading at sustained high premiums during import clampdowns, and so on. What makes precious metals special is that they are also financial assets and stores of value. A high domestic silver price is not just about industrial users scrambling for feedstock. It is also a thermometer of household and institutional trust in the currency and banking system. Once Chinese domestic prices decouple in a meaningful way, the world's eyes turn to the physical flows. Are imports surging, indicating that Western vaults are being tapped aggressively? Are exports collapsing, confirming that metal entering China is not coming back? Out? Are Western inventories declining at an accelerated pace, especially in forms that are attractive to Eastern buyers? Any affirmative answer tightens the link between a local Chinese premium and global systemic stress. In theory, Western prices could remain lower for some time, anchored by financial conditions, speculative positions, and the inertia of existing hedging programs. In practice, the longer and wider the divergence, the more it invites pressure on the weaker side of the system. The paper markets, whose smooth functioning rests on the assumption that physical metal remains widely available near benchmark prices. For now, the $100 label belongs firmly in the future hypothetical category. Chinese silver does not trade at anything like that level in reality, but the mechanism by which it could reach such a price domestically without an immediate equal move in Western markets is real, and it is rooted in how China's financial architecture interacts with the global silver supply chain. The suspense lies in whether those mechanisms will ever be activated strongly enough, by policy choices, by industrial need, or by macro stress, to turn what is now a speculative narrative into a concrete market event that Western traders can no longer ignore. Turn now to the physical stockpiles that underpin all this theory, and the phrase, Western vaults are being drained, becomes less dramatic and more descriptive. The major Western hubs for silver storage are London, New York, and a handful of other centers such as Zurich. Trade organizations and exchanges periodically publish aggregate holdings for certain vaulting systems. When you look at these time series over the last several years, a clear pattern emerges. After peaking around the time of the pandemic disruptions and financial interventions, reported silver inventories in key Western vaults have trended down. Consider London, traditionally the heart of the global bullion trade. The vaults associated with the London Bullion Market Association and the Bank of England hold silver for banks, ETFs, industrial firms, and sovereigns. Public data have shown that total silver stocks in London fell by hundreds of millions of ounces from their peaks earlier in the decade. In New York, COMEX warehouse reports reveal a similar decline in registered silver, the portion explicitly flagged as available for delivery against futures contracts. Eligible silver, owned by private parties but meeting exchange specs, has also swung lower at times, even if not as dramatically. None of this proves imminent scarcity by itself. Starting levels were high, and absolute amounts remain large. Yet direction and trend matter. If every year, net of all inflows, more silver leaves these systems than enters, you're observing a structural drawdown. Where does the metal go? Customs and trade data give some clues. European and North American exports of refined silver to Asian destinations have increased in various periods, often in line with strong bar and coin demand figures from China and India. Refiners in Switzerland, which process a significant volume of global precious metals, report throughput that often converts large, good delivery bars held in Western systems into smaller units more suitable for Asian retail buyers and domestic exchanges. From there, the trail often goes dark because once bars enter the vaults of Chinese banks, state entities, or private households, they effectively vanish from Western statistical radar. The metal is not necessarily lost to the world, it still exists, but it is no longer easily mobilized to support Western paper markets. At the same time, mining and recycling are not easily ramped up to offset such flows. Many silver mines are in jurisdictions far from the main consuming centers. Political risk, permitting delays, and environmental constraints all slow new supply. Recycling responds to price signals, but most silver is used in tiny quantities in dispersed products, making it harder to recover economically than gold from jewelry or bars. So, while higher prices over time can stimulate more production and more efficient recycling, they do not produce an instant glut of new metal in London or New York. The result is that incremental Eastern demand is satisfied first by drawing down above-ground Western stocks, not by an immediate surge in fresh output. What keeps this process from alarming Western participants is that it happens gradually and is cushioned by the complexity of the financial system. If an ETF sells off and its holdings shrink, this can be interpreted as bearish investor sentiment. Analysts might say, funds are dumping silver, but in physical terms, someone has to buy that metal. If the buyers are Eastern entities who take delivery, the headline story of ETF outflows doubles as a story of vault drainage, one that is not obvious unless you connect the dots between custodial reports, customs data, and refinery activity. Similarly, if COMEX registered inventories fall, the usual explanation is that owners simply reclassified metal from registered to eligible, expressing no desire to make it available for futures delivery. Perhaps they have other plans for it. Over time, a succession of such private decisions can have a cumulative effect that is far more significant than any one data release suggests. As Western vault stocks thin, the market's vulnerability to shocks grows. In normal times, a sudden increase in delivery demand on an exchange can be met by coaxing more metal into the registered category, paying a slightly higher lease rate, or sourcing from ETFs and bullion banks. In strained times, each of these safety valves is partially clogged. Holders of eligible metal may be reluctant to reclassify it if they suspect future scarcity. Lease rates, the interest rates for borrowing physical metal, may spike as fewer owners are willing to lend. ETF holders may be less willing to redeem or sell if they see that physical premiums are rising independently of futures prices. Eventually, the chain of somebody else will provide the metal reaches an end, and the cost of prying loose the marginal ounce explodes. This is the environment in which a serious east-west price divergence could appear. Suppose Chinese or Indian buyers continue to bid aggressively for physical silver, driving up local premiums. Western futures markets may initially shrug this off, especially if macro conditions, say high real interest rates or a strong dollar, suppress speculative buying in New York and London. But the physical arbitrage link will still try to do its job. Traders will look to withdraw metal from Western vaults, ship it east, and collect the premium. Every successful arbitrage trade tightens Western availability further. Eventually, if Western financial players do not join the buying, the vaulted stock becomes too low for comfort relative to outstanding claims. The weakest hands are flushed out first. Short sellers who cannot source metal to deliver, levered longs forced to accept cash settlement instead of bars, and hedgers who discover that roll costs have spiked. At some point along this curve, the narrative changes. What was once a story about obscure inventory movements becomes a story about confidence. If enough participants begin to question whether paper silver truly represents an easy claim on metal, they may demand higher risk premiums, shift to allocated storage, or simply buy physical themselves rather than holding futures or unallocated accounts. These behavioral changes feed back into the system, further draining readily mobilizable stocks and undermining the complacency that allowed high paper to physical leverage to persist. The stage is then set for a more sudden repricing, in which Western benchmarks lurch upward to catch up with the reality that the marginal ounce is being valued much more dearly where it is most desired, in the East, outside the reach of Western financial engineering. All of this converges on a single, uncomfortable possibility, that silver might one day be revalued not by a gradual orderly rise in futures prices, but by a fracture between paper benchmarks and physical reality, with China or the broader Eastern Bloc acting as the catalyst. $100 silver in China is a vivid way of expressing that fracture, even if the specific number is speculative. The key is not the exact price tag, but the conditions under which such a disparity could emerge and persist long enough to force the rest of the world to adapt. Those conditions include a tight physical market, sustained Eastern accumulation, constrained arbitrage, and a Western financial system heavily reliant on derivatives and unallocated claims. Add macro stress, ranging from inflation scares and currency worries to geopolitical rifts and sanctions, and you have a backdrop in which tangible, transportable wealth like silver becomes more appealing to actors who cannot fully trust dollar-centric channels. China, with its combination of industrial demand, enormous savings pool, and semi-closed capital account, stands out as the place where such dynamics could become most visible. By bidding up silver domestically, and whether deliberately or incidentally, drawing down Western vault stocks, it could force a reckoning over how silver is priced globally and who really controls the marginal ounce. For miners, such a shift would be both opportunity and challenge. A much higher silver price promises richer margins and the incentive to invest in new projects, but the path there might be chaotic, punctuated by regulatory interventions, windfall taxes, and political scrutiny over resource nationalism. For refiners and logistics firms, the volatility would create bottlenecks and windfalls in equal measure, as they become the indispensable conduits for metal moving from old hubs to new. For industrial users, especially in the solar and electronics sectors, a step change in silver prices would force design changes, substitution efforts, and hard choices about whether to absorb costs or pass them on.